Hello and welcome back, everyone, to the third episode of Almus Weekly Windup. This is your host Swaraj, and with me I have our market expert JK, who will take us through the week which has gone by. And what a week it has been! This week was quite eventful. We had the ECB meeting. We had new developments in the Russia-Ukraine tussle with a lot of influence on commodity prices, energy prices, lot of moves on both sides. Like we had an up move and a down move. So JK, my first question to you is on oil, because we saw a high of around $138 a barrel for Brent, and since then we have corrected quite a bit. Uh, do you think we have somewhat seen a top in oil prices, or like what are your expectations with oil?
Hi, Swaraj. Good to speak again. Yeah, actually, both oil and dollar have been used as potent weapons in geopolitical issues, and it is in full play now. In 70s, we had seen oil-producing countries imposing embargo on importing countries, resulting in a huge spike in oil prices. Oil buyers used it later against Iran as a sanction to achieve nuclear deterrence. In the current situation, very large importing countries are using it as a weapon to counter aggression of Russia. So after the Ukraine attack, we've seen the oil price rise to close to 140 and a rise of 40% since the attack. And that is a huge headwind for big oil importing countries. For countries like India, who are already running a big trade and current account deficit, it's a huge macro challenge to manage. After some peace overtures from both sides, oil has corrected, but still trades well above 100 psychological level and much higher than where we were before the attack. Yeah, unless we see the prices breaking below 100 substantially or sustainably, I would say, there will be no relief for our economy. And much depends on how the peace negotiations between Russia and Ukraine proceed. For your query whether we have seen the top, I have seen oil moving between one extreme to the other in much frequent time frames than other asset classes. We had seen oil at one, or rather in single digit 2 years back, just before the pandemic, and where we are now at 130, 120. So these things cannot be visualized when it will happen, but possibly I won't rule out a good correction in oil from these levels. And that will be good news for India.
Right. So, yeah, you're right. I do remember during the COVID pandemic, we saw single digit oil prices. And I think a lot of even derivative traders were stuck because of issues with delivery that they had to take in because of the negative oil prices also at some point.
Yes.
Yeah.
I can add one more thing. From the way oil dropped around 25% in one session, from 139 previous day to around 105, it clearly shows how much of speculative positions have been built in.
Right.
I'm sure bigger players were positioning themselves for the geopolitical events in some way or the other. And one cannot say whether fundamentally it should be whether at 130 or 120. It all depends on supply demand situation. And supply demand situation was anyway, in for favor of the demand after the post-COVID recovery of the economies. But supplies had gone down already. So because the OPEC had not restored to the full extent of their capacity. And what happening at that time is only resulted in prices gapping too much. And that has a lot to do with the speculative positioning. I think we have a good case for oil correcting below 100.
Right. So, lot of speculative positioning on oil, guys. So now that we have somewhat covered what has happened with oil, we also had the ECB meeting this week. So what were the key highlights of this meeting, JK?
Both ECB and US inflation numbers, the big economic events of yesterday, were not good news for the markets.
Mhm.
And they are coming at a time when the economies are already assessing the impact of war. ECB surprised by planning to end bond purchases earlier than previously planned. And the language shows that they may not be averse to a rate hike if conditions so warrant. Now, markets are actually discounting a 40 BP rate hike in Europe, and the yields in German bunds, which is a benchmark for the Eurozone yields, has again pushed up to positive territory of 0.3%. It just dropped back to negative yields just after the war, but back up at 0.3% now, which is really an indication that financial conditions are tightening in Europe as well. As far as the US inflation number is concerned, it just confirmed the market expectation of around 7.9%. But that's not something to rejoice about because it is a new 4-decade high. And it only cements the expectation that Fed will be moving its rates higher in almost all the meetings this year, barring any large negative fallout from the war, slowing the economy substantially. Stocks have, of course, continued their down move in this week, and bond yields have returned to their recent peak after yesterday's data. Global stocks actually lost about 6% this week and technically look set for more losses. At least I would say there is no sign of a reversal of downtrend.
Mm-hmm.
Really, investors are looking for some good news, and possibly the weekend will provide some, but so far it has been eluding.
Right. So 4-decade high inflation in the US and tightening financial conditions in Europe, with even German yields turning positive from the negative territory. If I were to move back to the domestic front, JK, we had election results for 5 key states this week. What has been the market's take on the election results?
See, the current scenario where we are staring at big economic challenges, state election results do not have much of an impact. Although it confirms that the political stability has no semblance of a threat in India. In medium term, it does augur well, as the ruling party might be able to increase its strength in the upper house of parliament, and that will in turn help pushing through major economic reforms. However, near term, both stocks and currencies are driven by global factors, geopolitics and monetary policy. And in the currency, we see strong bias from importers to hedge on any good dip in the dollar. And only constant presence of RBI at the top, around 77, which incidentally we were close to breaking this week, that ensured we did not see a big slide in the rupee. Currently, the line in the sand is at 77.
Right. And speaking of currencies, we also had a sell-buy swap done by the RBI. JK, for our listeners, can you just explain what a sell-buy swap is?
Okay, the sell-buy swap is in the foreign currency, is an operation which is meant to address the local and the foreign currency liquidity. So RBI, when it sells and buys dollars, it sells for the near term in exchange for rupees. What happens is it increases the dollar liquidity in the short term and sucks out equivalent rupee liquidity from the system. So that indirectly addresses inflation in a way, because money supply, local money supply is curtailed. At the same time, RBI pushes its dollar assets into a forward maturity of, in this case, it is 2 years. So RBI will be buying back those dollars, the 5.13 billion which they got in the auction, places it in the forward maturity of 2 years, and at that time they would be buying the dollars and releasing that much liquidity to the market. So in effect, there is a sell which is matched by a buy, but at different maturities. Net impact on the spot rate of dollar against INR will be minimal, almost non-existent, I would say. It only is managing the liquidity of dollars perhaps if there is a large inflow, that would be offset by the near-term sell of the dollar by RBI, because they would be observing the inflows. That is the only impact I can see right now. Yes, of course, because the market has already gone and received the premium at 4.25% for a 2-year tenor, possibly the receiving pressure might be less from the market side, and that can slightly push up the premium in the coming days. However, with the US yields also going up, the differential between India and US narrowing, the premium should actually be naturally be going down. So it's quite balanced. I don't see a big impact, but this is the overall impact of the operation as far as the liquidity conditions are concerned.
Right. So basically, if I were to understand, it is just a way of managing liquidity, which is done by RBI.
Yes.
Yeah. Right.
Yes.
So guys, I hope you understood what a sell-buy swap is. And that's it for this week. Stay tuned for the next episode of our weekly wind-up. Thank you so much, JK, for coming in again and explaining such concepts and the week that has gone by. Always a pleasure to listen from you. And for those of you who want to listen to JK and even our money market expert, Mr. Pankaj Rathi, more often, we have our daily Almus Market Mornings, which is hosted by my colleague Shikhar, and it's released before 10 a.m. every weekday. So thanks, guys, for tuning in. Thank you, JK, once again for coming in. Thank you and take care. Bye-bye.
Yeah, I wish everyone a happy weekend. Hopefully, we have some positive news emerging by Monday to give some relief to the investors. Thank you very much.
Yeah, even I hope so. We have some positive news, and even with some cool down in the Russia-Ukraine situation to bring some more certainty.
Thank you.
Thanks, everyone. Bye-bye.